Which states are winning the estate tax race to the bottom? Imagine a state where your heirs might not have to pay any estate tax at all. That's what some states are doing to attract wealthy residents and their assets. As of 2025, many states have either eliminated their estate taxes or set very high exemption limits. These states are making estate planning simpler and more affordable for high-net-worth families. States with no estate tax are leading this race. For example, Pennsylvania does not impose a state estate tax. Instead, it has an inheritance tax that applies to certain beneficiaries but no estate tax on the estate itself. This makes Pennsylvania appealing for estate planning because it reduces the tax burden for heirs. Other states like Florida, Nevada, and Texas also have no estate tax, making them popular choices for those looking to keep more wealth in the family. Some states have increased their estate tax exemption to match or come close to the federal exemption. Connecticut is a good example. Its exemption for estate tax is now $13,990,000 in 2025. That means estates valued below this amount do not owe any state estate tax. This high exemption level means fewer estates are taxed, which is a big plus for estate planning. On the other hand, some states still have lower exemption thresholds and higher tax rates. Massachusetts has an exemption of around $1,500,000, and estates above that face a tax rate of up to 16%. Oregon and Rhode Island have similar rules with exemptions around $1 million to $1,800,000. These states are less attractive for those wanting to minimize estate taxes. The District of Columbia has an exemption of nearly $4,973,000 in 2025. Estates over $10 million face a graduated tax rate up to 16%. While the exemption is decent, the higher tax rate can still impact larger estates. Washington State has a graduated estate tax starting at 10% for estates over $2,193,000 in 2025. The rate climbs to 35% for estates over $9 million. That's a significant tax burden compared to states with no estate tax. New York has an exemption of about $7,160,000 in 2025. Estates just over this amount face a 26% tax rate, and there is a tax cliff at 105% of the exemption. This means if your estate slightly exceeds the exemption, the entire estate could be taxed at 16%, which complicates estate planning. For elder law and estate planning professionals, states with no estate tax or high exemption levels are more attractive for clients. These states allow families to preserve wealth and avoid complex tax strategies. Conversely, states with lower exemptions and higher rates often requiring more planning, like gifting assets early or creating trusts to reduce taxable estate size. In summary, the states winning this race are those with no estate tax or exemptions aligned with the federal level, such as Pennsylvania and Connecticut. States with lower exemptions and higher rates, like Massachusetts, Oregon, Rhode Island, Washington, and New York, are less favorable for estate tax planning. Knowing these differences helps clients make smarter choices about where to live and how to plan their estates effectively.